Hi team, this is AJ with Trading Trainer on the afternoon of Sunday, July 8 with your Trading Trainer Daily Insights. What we're going to do here is take a look at our Trading Trainer Daily Pick Report Generation tool. We're actually going to create for ourselves a pick list. From this pick list, we're going to find a candidate, do a full analysis on it, see if it deserves to be on our hot list. If it does, we're going to craft follow the rules, pick option trading strategies, pre-select options, put together preliminary exits. Team, we're going to do actually a deeper dive on Lululemon. 128.54, up 3.23%. 128.54 is a little bit overpriced. Volume and balance, just fantastic. Now Lululemon with the sharp chart shows consolidation. Maybe the 20 has a little bit of ways to come. Point and figure chart shows that we're at some sort of top, but kind of topping out. Not real any resistance above or below. And then this is what I like. The implied volatility is so low compared to historical volatility. Let's pull up a chart. So if I pull up a chart on Lululemon, what you can see is what we identified in our pending breakout. So if you remember our pending breakout, we had support and resistance at 124 and 129.75. Let's go ahead and line that up. So here's 124 and here's 129.75. And I'll go to a 3-month chart so you can see that a little bit better. Put it on candlesticks so you can really see it better. And so we're looking at this channel here. Now, again, this was our active setup. What about a passive setup? So here's our resistance, 129.75. Here is our support at 124. So halfway in between resistance and support is the middle of the channel at 126 and 7/8, 0.875. Now I went ahead and used the Thinkorswim tool, and I looked up implied volatility because the implied volatility found here on the CBOE chart is all of the calls and puts averaged out into the mean. But I want to look at simply the series, in other words the expiration dates of the options I'm interested in. So I'm interested in August and September. Now again, they've done a good job of measuring implied volatility and even the movement of said implied volatility. But again, that's all of the candidates, and I'm just interested really in the candidates right around the middle of where I'm at. So if I take for August the implied volatility 28.99, 27.60, 27.98, and 27, and average those together, do I get 29.19? No, I get 27.9, as you can see here in my write-up. Let's get rid of this one. This is the active trade here, and that's something we set up before, so 0.278925 to be exact. And also I decided to calculate it for September, and as you can see here, instead of the 39.91, we're just taking the implied volatility around the digits that we got, and we're not too far off. 38.44. If you wanted to use the whole month, you could. Let me show you something else that you can do. You can take a look at the product depth with it, which is basically your volatility skew diagram, and it's showing us all of our strike prices, and it's showing them for all of the expiration dates. Now, generally, if there's no big event coming, then your implied volatility should be a smooth curve in both directions, as you can see here, as we get further and further out with our August, September. So our September hardly had any burp. Definitely the near term had a big burp, but don't forget that Vega on near term options quickly goes to 0. So a nice medium is this August. So we're going to use the August implied volatility. I calculated 27.8925%. Thinkorswim is calculated across the full spectrum at 29.19%. Again, either number, I like using my number, but it's not going to change the standard deviation too much. So We take the square root of the number of days over 365. So we can do that calculation right now, actually, so you can see how it comes out. So if I take 40 divided by 365 days, and then take the square root of said number, multiply it by the implied volatility I calculated, 0.278925. Remember, this is a decimal, not a fraction, times the center point of my number, 126.875. I get $11 and basically 72 cents. And so from that $11.72, I'm going to subtract and add it. And this is my probability curve analysis. So coming on back to our chart, we want to look at basically 1 and 2 sigma, 115 and 138, and see if we are overpriced or not. In other words, if we have a break, are we at a point here where we should be able to get past that 115, which is all the way over here. That would be going past this rising window here for those candlestick aficionados, or even higher. So 115 and then even 103, which is down here. So if we crash, are we going to crash big? Because that's what would need to do, because this is how much those August options are priced out, and it would have to happen before August. Question is that going to go down? And that's something that we're going to check for ourselves. The implied volatility would need to go up even higher for us to make any more money than this. This is already telling us that these are pretty high priced for our series of options. With that said, if we decide to go in on this, we'd want to select a straddle or strangle at 126.875. Now again, coming back to our option chain in August, we have 120 and we have 125s. So how do we get 126.875? Well, we're going to have to do a hybrid, because we want, again, the 126.75 is right where we believe the middle point is. And so follow-through rule or option, pre-selected options might be something like we have a straddle at 125, and that's going to have the smile curve center point at 125, and then we're going to have a strangle at 125, a strangle of 125/130, and that's going to have a center point of 127.50. And so what combination of the two do we need to get 126.875 or close? And so if we can afford 9 contracts, what I would say is we would probably want to do 7 contracts of the strangle, and then 3 contracts. I said 10. If we wanted to do 7 here and 3 here, so let's do the weighted average. So 127 times 5 times 7, there's 7 of them, plus the 125, plus the 125, plus the 125, divided by 10. So we're at 126.75. We're looking to get at 126.875. You'd have to be able to afford like 20 contracts in order to nail it down, because then you would do something to the effect of 17 contracts out of 20, but let's stop with 10. So basically our pre-selected options are going to be 3 quantity straddles at 125 and 7 quantity strangles at 125. So our follow through rule is enter hybrid trade of 3 straddles and 7 strangles when price crosses, or when price is at 126,875. 126,875. So I'm within 12 cents. And so what that's going to do is that's going to set me up if there's going to be an implied volatility increase above and beyond this 0.278925. We'll get an appreciation just on that alone. And then of course if there's any price action off that center point, we'll have everything working for us. So that's our follow through rules. It's that easy. And then our preliminary exit, exit the straddle after positive at reversals. So calls at tops, puts at bottoms. So once this thing is profitable and to your liking, usually it's after some sort of either passive breakout or a jump in implied volatility, then you look for a top for the calls to get out and puts to get the bottoms out. Team, pretty straightforward. This one has a lot of analysis up front, and the one thing you really want to take a look at besides comparing our implied volatility to our historical volatility on the overall symbol is looking at the volatility skew graphs is definitely not a bad thing, which is what we've got here, and looking at the probability curve the way that we calculated it with the center price and with the implied volatility as we calculated it, and going from there. Like I said, folks have already priced in a pretty good move down or up into the position, and that's what it would have to do in the next 40 days. Is that possible? Well, it did it once before. So it depends on how stagnant you are. And could the anticipation of the next earnings, which we see here looks to be pretty good, could that anticipation get you? Could that get us going? With that said, what I'd like you to do is take a look at our passive setup compared to our active setup. Take a look at our follow-through rules, our preliminary exits. That's all I've got. Please take care.